What if I told you the banking system is designed to confuse you, and that by keeping your finances simple, you can stop losing money, build wealth faster, and take back control of your future? Stick around, because today we're talking about why simplifying your finances is the key to reaching financial freedom, and how you can start right now. Hey everyone, and welcome to Simple Finance Bytes, where we break down personal finance in plain English for people working toward financial independence and the simple finance way. I'm Ernest, and today we're diving into why simplify your finances isn't just a catchphrase. It's a real strategy that can change your life. If you've ever felt like your money disappears faster than it comes in, or you're always juggling too many accounts, too many apps, too many bills, you are not alone. This episode is going to help you clean all of that up. So grab a cup of coffee, take a deep breath, and let's get into it. The financial system doesn't benefit from clarity. It benefits from confusion. The more accounts you have, the more likely you are to miss a fee, miss a payment. The more products you juggle, the more likely you are to overpay. Traditional banks are counting on it. Overdraft fees, maintenance fees, account minimums. These are all ways to extract money from people who don't have time to track everything. Even worse, extract money from people who already don't have money to begin with. Incredibly predatory. When your finances are complicated, it's hard to know where your money is going. It's even harder to build anything long term. Let me tell you how I learned this the hard way. I am someone who researches personal finance on a very regular basis. So as a result, I sign up for all kinds of bank accounts and debit cards and all these kinds of things to really dig into these things and understand, what are they actually offering here? And do they truly benefit the average person? And while there are a few products out there that do, and we will definitely talk about those in this podcast and in future episodes of this podcast, the vast majority do not. And they're designed that way on purpose. Again, the more they can confuse you, the more they can get you with these little fees and random things that end up taking money out of your pocket instead of keeping money in your pocket. That's one of the reasons we have very high recommendations around credit unions, not all, but most, as well as certain fintechs that are designed to work with the average person as opposed to designed to take money out of their pocket. Before we move on, make sure to check out our latest article at simplefinancebytes.com. It covers everything we're talking about today in detail, and you can sign up for our free monthly newsletter while you're on there for more tips to keep your money working for you, not against you. So what does simple finance actually look like in practice? Well, here's a quick framework. Number one, use a local credit union, but only a good one. Your main banking should be through a local credit union with zero fees. If they charge you for checking or savings, find a new one. Keep part of your emergency fund there, but don't use it for online purchases or subscriptions. Think of it like your financial bunker. You want to make sure that that is isolated from online payment services or P2P, payment services, things like that. You want to isolate this from that. This is kind of your nest egg, if you want to call it that, in terms of finance. And the reason you're using a local credit union is because local credit unions are designed to serve the members, not the shareholders. And that's what matters here, the local credit union. But as I said, not all credit unions are created equally. Some of them have lost their way, and they're starting to do things like introduce all these various little junk fees, nickel and dime people, basically behaving like the big banks. If the credit union is doing that, walk away. Look for a credit union that's NCUA insured. So NCUA is sort of like the FDIC insurance that banks have, but it's a different organization called the NCUA. Make sure that the credit union is NCUA insured. You can look that up on the NCUA website. Make sure that it has free ATM access within its own credit union network. So not just at its own ATMs that might be attached to the physical credit union, but a lot of credit unions participate in a co-op ATM network, and some of them also participate in a shared branching co-op. And we'll definitely talk about that in future episodes. Make sure that the credit union doesn't nickel and dime you with monthly service charges of any kind. Ask questions before you open the account, especially if they require membership conditions. Many of these are just a formality, like a one-time $5 donation to a charity they support, or just a $5 deposit to open the savings account with them. But if there is a membership condition, make sure you ask questions before you open the account. And a legitimate credit union will be happy to answer any questions you have before you ever open an account. If the credit union is acting cagey in any way, or like they can't be bothered to help you, walk away. You found a bad credit union, or at the very least, you found a bad employee of the credit union. Either way, do research, look online, read reviews, talk to other people in your vicinity, and find the best credit union you can find. Now, as we said, the credit union is kind of the anchor. It's your bunker. It's your nest egg. It's your safe space as far as where your money sits, where you have immediate local access to it in a branch if you need it, but you don't really want to connect it to the internet by putting things online, like connecting a PayPal account to it or something like that. You want something different for that. So our strategy is to pair an online bank or a fintech. Fintech is short for financial technology or financial technology company. Pair it with one of those and use that for all of your online transactions. I actually do that personally. Use a service like Discover Bank or PayPal for your day-to-day transactions. I personally use Capital One Online Bank and have my PayPal, Venmo, Cash App, and everything connected to that Capital One account. And that Capital One account is primarily only used for day-to-day transactions and online transactions, things that I don't connect my credit union to. These type of services like online banks or fintechs, they give you mobile access, meaning you can do everything from your phone. There are no fees, and they have great user interfaces, mainly because they're geared at getting people to use them as much as possible. So they make them look nice, they make them work well, they make them work fast, whereas the app for your local credit union is usually not something to write home about. And that's okay, because we don't need the credit union to do all that. Again, it's just your anchor. It's your rock and all your foundation financially. Now, when you use the online bank or fintech and you connect everything to that, as I mentioned, this creates a firewall. If your online account is compromised, your credit union and your savings are untouched. That's the whole point of this. You'll often hear people say, don't use a debit card, use a credit card, because debit cards are connected directly to your bank. And if somebody compromises your debit card, they take your money, and that could cause you not to be able to pay bills while the credit union or the bank is researching what happened. When you make this separation and you don't actually purchase things with your credit union debit card, you only use it for simple things like bill pay, and then you run all of your online and or day-to-day transactions through the online bank or fintech, then if something happens to that online bank or fintech, because that's the most likely place that things are going to get compromised, your credit union is safe. So should you need to go get cash or something while you're waiting for your new online bank debit card or PayPal debit card or fintech debit card or whatever it is to come in, you have cash accessible to get you by, and your main bills like your rent and things like that are being paid out of your credit union account anyway. So you're okay. That's really what this is about. You want to make sure that your credit union and your savings are untouched in the event of a compromise. For example, I use PayPal for nearly every online transaction where they support PayPal as a payment method. Behind that is either a debit card or a credit card that I'm sending it to, but I'm using PayPal because of the online protections and because PayPal doesn't actually share the numbers of my debit or credit cards. It shares a secure token with the merchant when I want to buy something. So it makes sure that that transaction is secure online. It's easy to move money around, and I connect it to apps like Venmo, and I don't need to worry about exposing my main accounts when I buy something online. If a place doesn't support PayPal, then I use a specific credit card that I only use for online transactions just for that. So that if something happens and there's a compromise of that website and my credit card number gets leaked, I only have to call one institution, have a new card issued, everything's fine. If you don't use credit cards, same methodology, but with a debit card, whether it's a PayPal debit card, a Venmo one, a Cash App, doesn't matter. Same idea. Again, this is for risk mitigation or lowering your risk with banking, online banking, and online purchases. The next thing to simplify your finance is to eliminate all consumer debt. And I know this is a big one for us here in the United States because the United States has the largest amount of consumer debt that has ever been over our heads in the history of this country. And it happens for many reasons. I often say, regardless of the plan you have, life happens. That's okay. Recognize that it happened and try to move forward. So, consumer debt are things like credit card debt, personal loans, buy now, pay later, all that kind of stuff. If money is going out of your bank account on a regular basis and it's not for a mortgage or for an auto loan, it's probably consumer debt. Well, student loans too, but probably consumer debt. You need to get rid of that as fast as possible because typically those have the highest interest rates. And when money is constantly going out, it's hard for you to save more money, hard for you to invest, hard for you to do anything. It makes your finances much more complicated, and we're trying to go the other way. So pay down all consumer debt. We have several articles on our website that talk about different methods like the snowball method, the avalanche method of how to get out of debt. We can help you with that. But that's the next thing you want to do. Eliminate all the consumer debt. So if you're using something like Klarna or Affirm or paying the bare minimum on your credit cards, you're basically signing over your future income because you have to keep paying that to somebody else, namely a bank. Simplify by setting up a snowball or an avalanche plan. Get those balances to zero and don't look back. Don't keep charging to those cards. Once you eliminate consumer debt, you will see the level of peace and freedom already coming into your life. And then you just take that and expand it. Now, how can you approach this realistically? When you're a business, you have two different options when you want to tweak your balance sheet. You either have to cut expenses or increase revenue, increase income, get more money in the door. Sometimes it's much, much harder to get more money in the door than it is to cut expenses, especially when you know you have expenses you can cut. On this podcast and on our website, we talk about both approaches, cutting expenses and increasing your income. But for this section of this podcast, we're talking about cutting expenses and specifically cutting those expenses to the bone. One of the examples I like to give is to use an MVNO like US Mobile or Mint Mobile as opposed to getting cellular phone service directly from the big companies T-Mobile, Verizon, AT&T. You can get the same level of service much, much cheaper by using an MVNO. I personally use US Mobile, but I have also used other MVNOs in the past. I've used Mint, I've used Red Pocket, I've used so many of them. And to be honest with you, the level of service is just as good as it is directly with the big companies. The one exception to that would be if you are a heavy data user because let's say you run a business, let's say you are a real estate agent and you're constantly using your laptop from your vehicle to do all kinds of business related things. So you're using a lot of data. In that case, it can make sense to go directly with the big provider for two reasons. If you go direct with them, you're able to get plans that give you much more data at a reasonable cost, but it's a business expense. You get to deduct it. So in that case, it's okay. But for everyone else, including other small business owners, I myself am a small business owner, and I still don't work directly with the big companies because they charge too much for the paltry level of service they give you. Cut your expenses to the bone. MVNO is one great example. Streaming services are another one where people get way out of hand. They might have 2, 3, 4, 5, 6 streaming services. Now, I'm not someone to say live like a monk. That doesn't work for anybody. That's going to cause all of this to fail. What I'm saying is use a system that makes sense here. For example, If you like 4 streaming services, say YouTube, Apple TV, Amazon Prime, and Netflix, cycle them. Subscribe to them for only a month and then let them expire at the end of the month, and then go from one to the next, and just keep them in a rotation so that you're only ever paying one at a time. If you can just cut back to one only and ignore all the other ones. For example, a lot of the content that's on Amazon Prime, on Netflix, on Disney, and all these other ones is also on YouTube, which is why YouTube is the only one that I pay for, YouTube Premium, and I get all my content through there. And if something's not available through there, I will try to purchase it directly either through Apple TV or whatever the case is, so that I own the digital copy as opposed to paying more subscriptions. The next one is for those that are okay with using credit cards. I realize that many people out there are against credit cards and don't want to use them for various reasons. I fully respect that. I'm a huge fan of debit cards, and I talk a lot about debit cards on my website, simplefinancebytes.com, as well as on this podcast and on YouTube and other areas where I publish content. I love credit cards and I love debit cards. If you do not know how to handle credit and credit cards, you should not be using them. You should be using debit cards. Ignore anyone who tells you about how dangerous they are. As long as you know how to use them safely and securely, you will be fine. However, if you do like using credit cards, or you're okay with credit cards, do not get out of hand with the number of credit cards. There's a lot of content right now online, especially on YouTube, about travel hacking and credit cards and people having 20 and 30 and 40 credit cards. That's insane. And I'm not even saying that there's anything wrong specifically with having the credit cards. It's the managing of all those credit cards. If you do one thing wrong, or you forget one thing, you could wreck your credit score for quite a while. Keep it simple. Use 2 to 3 credit cards. That's it. My actual recommendation for most people is to keep it to 2 credit cards, one from each different issuer. An example of what I mean by that is one from American Express, one from Chase. I'm not going to name specific credit cards because that is very subjective to your personal finance, but what I'm saying is you have 2 of them, one from each different issuer. The reason is, if something ever happens to one of those credit cards, there's a fraud on it and you have to call in and have them shut the card down and issue you a new one, you have a backup to work off of. Or if something happens where you lose your relationship with that bank, say Chase Bank doesn't want to do business with you for some reason, go look online. It happens all the time. And sometimes there is no reason and they give you no reason. They just shut down all your accounts. If you only had cards from Chase when that happens, you are in trouble, at least for a little bit. So the best thing to do is to have 2, each from a different issuer. That's what you want to do. And if you do have credit cards, the golden rule is you must pay them off in full every single month. Never leave a balance. Never carry a balance. Never pay interest to a bank. Because the minute you do that, it doesn't matter what rewards, what cash back, what anything that card has, you've already lost the game. Because you're talking about them giving you 2, 3, 4, maybe 5% cash back and then charging you 20 to 30% interest. That math doesn't work. So if you are going to use credit cards, never ever carry a balance. Always pay them off in full every single month. Don't overcomplicate it. It's very simple. As far as the combo there, a great combo is one flat rate cashback card, say a 2% cashback credit card, and then one that covers travel or dining, right? So travel cards have specific protections for those who travel a lot. I'm a frequent traveler. I have a travel card. But if you only travel once or twice a year, or you're only traveling mainly by vehicle and not by airplane, you really don't need a travel card, despite what people tell you. There are other ways you can do it. We are going to discuss them on future episodes of this podcast. One of my favorite things to talk about is what we call OTAs, online travel agents, things like Expedia or Booking.com. We will have entire episodes that deal just with that in the future. But as far as the credit cards, one travel credit card, maybe a dining one, and one flat cashback. That's it. More cards means more risk and more mental clutter. And the idea here is to simplify everything, to have the least amount of mental load and clutter as possible, because as you know, we have enough of that in our lives already. We don't need more. If this is hitting home for you, hit pause and visit simplefinancebytes.com right now. Sign up for our free newsletter. Inside that newsletter, we send it out once a month. You'll get tips like this in your inbox each month, totally free, no spam, just value. You can cancel it anytime, and we respect your unsubscribe if you send it. Our goal is to provide the best content in this area, and we think our newsletter is awesome. But if you ever disagree, unsubscribe. No harm, no foul. Now, I obviously have named the website and this entire effort Simple Finance Bytes because I'm a huge believer in the system that I've built, the Simple Finance Bytes system. It covers many different things from budgeting to investing to day-to-day finances, securing your finances, cybersecurity, all these kind of things in the simplest way possible. Because the simpler it is, the less brain energy you're putting into it, the more you can put into your family, your friends, your children, your life. Don't let finances take over your life. That's the point here. So when you simplify, everything moves faster. For example, you stop losing time managing a bunch of different accounts. You stop losing money to late fees, junk fees, forgotten bills. You get more mental bandwidth to focus on investing, saving, and planning long term, and more importantly, spending time with your friends and family, because that's what actually matters. Now, let's bust a few myths while we're here. Here's myth number 1. I need a lot of credit cards to build credit. You may see some of these YouTube videos of people with 20, 30, 40 credit cards and think that's the way I get to an 800 and something. That's false. 1 or 2 well-managed cards build credit just fine. I personally have about 7 or 8 cards at this point, but I was above an 800 score when I only had 2. So it has nothing to do with the number of cards. It's the way you manage them. Myth number 2. Bundling all my subscriptions is cheaper. Well, not if you aren't watching them. For example, the one that I really need to practice what I preach here is Apple One. That one I pay for a family plan of Apple One, and it has all these different things inside it. Apple TV, additional cloud storage, and all these things. Of that, there's only 2 things that matter to me. The additional iCloud storage for photos and videos of my kids and my family, and Apple Music. And even Apple Music is kind of iffy because I already pay for YouTube Premium, which comes with YouTube Music for free with it. So, but all the other stuff other people in the family use, so you can make the argument, well, everybody's getting value somewhere. But at the end of the day, those subscriptions are not being used to the extent that I can say that bundling them together is actually cheaper. It's not, it's just easier. But since at least one person in my family uses every single one of the services, I leave it alone for now. However, if you aren't watching your subscriptions, for example, if you have a bundle with Max and who knows what, and you're only watching Max and not the other ones, then only subscribe to Max. You may not be watching the other ones. Unused value is still a waste. Myth number 3, big banks are safer than online banks. That's also false. Many online banks are FDIC insured and actually more responsive. And so when I say that, I say in order for them to be FDIC insured, that means they actually have to have a real legitimate bank charter, the same type of charter that your big banks like Chase, Bank of America, Wells Fargo, US Bank are going to have. They're going to have it. Discover is an excellent example, as is Capital One. They save money by not having a whole lot of branches locally, and they pass that savings onto you through better products and cheaper products, whereas the bigger banks are going to want things like account minimums and maintenance fees because they have to pay for all that real estate, for all the branches and all the people working in them. If you're using a local credit union, you don't need any of that. An online bank is just fine for you because anything you need to do in person, you go into your local credit union's branch. Now, this isn't about being perfect. It's about cutting the noise so you can move forward. Simple finance isn't boring, it's powerful. And it's what separates people who build wealth from people who stay stuck. So here's your challenge. After this episode, sit down and list every bank account, every card, every app, and every subscription you have. Then ask yourself, what can I cut? What can I merge? What am I paying for that isn't serving me? And I'm not asking you to go cut everything. What I'm saying is pick one thing and cut it. Wait a couple of weeks. Go back to your list. Is there something else you're not using? Cut it. Wait a couple of weeks. Go back to your list. You get where I'm going with this. This is an iterative process. This takes time. That's the way you have to approach these things. I started this website and podcast as a message to my 16-year-old self. If I had known then what I know now, this all could have been so much easier. I want to give you all of the information that I've had to learn the hard way so that you can benefit from it. I want to help as many people to have true freedom, and that starts with financial freedom. And as complicated as the financial industry wants to make you think that is, the truth is that it's actually simple. Simple finance is the key to all of this, and Simple Finance Bytes is here to show you how. Do you want to go deeper into these type of topics? Head over to simplefinancebytes.com, sign up for the newsletter, and read the full article that we last published. You'll find links to resources, tools, and more advice just like this on our website. And hey, if you're enjoying the show, give us a follow on Instagram, Twitter, and YouTube. But definitely the newsletter is the place to go because that's where we're going to put the majority of our content. Also, these are my own opinions. I'm not a financial advisor. This isn't financial advice. If you feel like you need a financial advisor, please go seek one out separately. This is financial education. There's a difference. At any rate, thanks for hanging out with me today on Simple Finance Bytes. If this episode has helped you think differently about your money, do me a favor. Share it with someone you care about. Family, friends, doesn't matter. Just share it. Tell them, hey, check this out. We would appreciate that. This show is going to be published on YouTube podcast, on Spotify podcast, and then it'll be shared to Apple Podcasts and hopefully everywhere else you get your podcast. So wherever you get this, rate and review us there. Let us know what you think. We appreciate the feedback. Also, feel free to reach out to us via our socials, primarily Instagram and Threads, but we will be on YouTube as well, and we will read the comments. We'll have some links in the show notes of this episode about the stuff we talked about, should you need further reference. But our website has many of these resources and has articles that span at least a year back. So please visit simplefinancebytes.com. Sign up for the free monthly newsletter and read the latest article. That's where real progress starts. Until next time, keep it simple, stay focused, and take control of your financial future.